Good morning, traders. It's Wednesday, November 23rd. Today will probably be a fairly light day with Thanksgiving just around the corner here tomorrow, so I wouldn't be surprised if we see fairly light volume and a relatively trendless market. Typically, light volume favors higher prices, so we might see the market kind of drift upwards a little bit, but overall, today is going to be a fairly light day, Friday. Tomorrow afternoon and Friday, again, very light. All the big players will be away, and or most of them are away for the week. So light volume favors higher prices, which is what we have been seeing. Now, it seems as though we've got a major shift in the markets. I did an interview with Howie Street yesterday, which I'll put the link below for you to listen to, but it seems as though the big picture, the big market trends, it looks as though the market has picked up speed, has changed, has reversed, and we're seeing the equities market potentially starting a new massive bull leg to the upside. And we saw the large cap stocks start to form a somewhat of a topping formation here, where large caps never broke down. They were forming a topping formation. We need them to close below this level. This is the SP 500 for it to confirm that it's in a bear market. And instead, what we've seen is it poked nominal new highs, put in somewhat of a bull flag formation, and we've seen a strong move back up to the top here, or a move up to new highs. So large caps have never been in a bear market, but the leading indicators like the transportation index, the Russell 2000, they had all broke down and had been moving lower. But now we've got this strong move to the upside in equities, and we're seeing potential rise in rates. We're seeing bonds fall. It seems as though we've got the momentum has picked up speed again for large cap stocks and equities, and that the safe haven plays could fall into the back seat. Now, with that said, if we look at the SPY, the short interest on the SP 500 is about 25 days, meaning it'll take 25 days with the current volume level for all the shorts to cover. A lot of people are short the market, betting against it to go down, and when they have to cover their short, that means there's 25 days worth of volume of people having to buy, and that's a lot. And we could see the market continue to grind and work its way higher, climbing that kind of wall of worry more or less. Now, if we take a look at some other indexes, here's the Russell 2000. Russell 2000 started to break down, went into kind of bear market mode, and it's recovered very nicely. Let me just move over a bit here. It's recovered very nicely. Now it's poked to new highs. Now we've seen a big consolidation like this before, where the market cleansed itself, and instead of rolling over and going into a full-fledged bear market, it broke out and then continued to run. And you can argue here that more or less all this here is potential a big cleanse in the market, a new platform, fully cleansing the market out, re-energizing, and now it's starting to break to the upside. And of course, the Russell 2000 was one of the leading indicators to indexes here to break down from this more or less this topping formation that we originally had here. And there's a lot of people still short the Russell 2000. In fact, there's 40 days short interest ratio on that. So after yesterday, we still have 40 days worth of buying potentially for the market to rebalance and cover its shorts. So there is a lot of upward pressure in the market, and this is a massive short squeeze, and there's potentially still a lot more behind it. Now, if we take a look over at the transportation index, the IYT, same type of thing. IYT broke down below this topping formation just like the Russell 2000 did, and was in more or less bear market territory. Instead, it's kind of built a new base here, a new platform, and it's broken and exploded to the upside. And we got about 20 days short interest there also, so still a lot of potential buying just for the market to rebalance itself. And this is very similar to this type of base, this level here where it came down, cleansed the market, stabilized before it started the next major bull run to the upside. And so where we are here, this current kind of pop is very similar to what we saw over here, where the market cleansed itself and then has a strong pop and move up. And it may consolidate for a while, potentially before it goes higher, but this here, the market has definitely cleansed itself, and we're seeing some massive power in the leading sectors like the Russell 2000 and this here, the transportation index. So that is a sign that we are probably back into full-fledged bull market mode in equities. And I think we've got higher prices to come looking down the pipeline. And of course, where we stand right now, we do have cycle highs in equities, and we've got a lot of cycle lows in the safe havens like bonds and gold. Um, so what we're looking for here is some type of pullback or pause in equities, and for the safe haven plays to have a pop and a rebound. And we'll be looking to scale out of bonds, potentially metals, as we kind of start to focus and look for new opportunities that now that the equities market seems to have broken to the upside and is potentially in the early stages of a new major bull leg up. So let's just take a quick look here at GDX. Here's the GDX. Overall, been in a bear market for many years, trying to put in a bottom, started to put in a basing formation and somewhat broke out of the basing formation. Gold and silver have not broken out of their basing patterns yet, but you can see we got a nice 5-wave correction here in miners. Still looks fairly bullish at this point, but again, it's back down into this basing formation. And with the US dollar potentially putting in a top, I think we could easily see gold miners and gold have a relief pop somewhere back up to test these recent highs, potentially back up a little bit higher. But all we're really looking for at this point here is more or less a pop in price and a drop in the U.S. dollar index, and I think we might kind of scale out of some of these positions for our long-term portfolio and move more weighted back into equities and to sectors that are showing very good relative strength and that are look ready to break out of some basing patterns. So one sector that's starting to look pretty good. If we go to the retail sector ETF. It's been putting in this massive kind of topping formation here. And of course, if it doesn't confirm as a topping formation, then it becomes a massive platform, a launch pad for the next takeoff. You can see here we've got this kind of sideways channel here. You could argue, again, that there is a potential head and shoulders here, no doubt, but what we're seeing is a lot of money moving into the market, and it looks as though the leading indicators that the equities are going higher, and this looks more or less like it's acting as a platform, a bottom to go higher. Now we've been bumping our heads above this a couple times. It has closed the highest it's closed all year. This is the retail sector. It actually has 135 days of short ratio interest, meaning it has to, a lot of people were short this index expecting it to break down and completely collapse back down to the last level down here where we saw the last kind of platform built. And if we start to break and hold up here to the upside, then we've got potentially a huge rally, quick target up here around the 51, which would be the next move, and then of course beyond that. So there's some sectors here that are showing some really strong basing patterns, tons of short ratio interest, meaning there's a lot of potential upward buying. People are going to start buying the sector back to cover their shorts because they're going to be caught on the wrong side. So we'll be looking probably to get more, start doing some sector plays, as there's a lot of areas that are showing some signs of very strong bases, and we could see some strong moves. Now keep in mind this week we've seen a pretty strong move up. Yesterday another strong move up, but it is a holiday week. Equities typically move up pre-holidays. Volume's usually lighter. So all these breakouts, these moves to new highs this week on light volume, have to kind of take it with a grain of salt. When big volume steps back in next week, we could easily see that step back down. So it's kind of hard to confirm if these are confirmed breakouts or not because the volume is light. The big players aren't here. They're kind of letting the market just do its own thing, and light volume typically favors higher prices. So that's kind of where we are in the grand scheme of things. And I talk about this in the interview with Jim Goddard and the report I did, which I'll link below. Now here's the US dollar index, and again we have taken an inverse play on this, and because we've got several levels of resistance, we've got a previous high right over here, which is where we're flirting with, and then we've got another high set just above there, and then we've got this other significant high over here. So we're anticipating that the US dollar index has had a nice run up, a little consolidation, second move up. It's hitting a couple levels of resistance where we could see a pullback down to fill this gap window somewhere over here. If it doesn't pull back right away, then it's going to have another level that it's probably going to hit and have some type of sharp, quick pullback. So we've got some overhead resistance here and a couple levels for the market, reasons for the market to pull back quickly. If we get a pullback in this gap fill in the US dollar index back down in this area, then we're going to see gold and probably bonds have a pop up in price, and that'll give us an opportunity to potentially scale out of those plays, and equities might be pulling back at the same time, and we could be looking for some new opportunities in some hot sectors or sectors that look ready to explode to the upside. So anyways, that's it for this morning. I will talk to you in a little bit. Bye-bye.